All right, in this PowerPoint presentation, we're going to go through the example problems for Chapter 10. The presumption is you've already listened to the Chapter 10 lecture, so if you have not done that, I would recommend that you go back and do that and then come back and view this one. All right, let's start with exercise 10.1. So on January 1st, Boston Enterprises issues bonds that have a $3.4 million par value. They mature in 20 years and pay 9% interest semi-annually on June 30th and December 31st. The bonds are sold at par. How much interest will Boston pay in cash to the bondholders every 6 months? Well, our formula for computing the interest is the par value times the semi-annual contract rate, which is going to be 50% of that 9. So this 9 is for the full year, so half of that would be 4.5%. And then we've got a total of semi-annual cash interest payment of $153,000. So they'd like us to prepare the journal entries for the following. The issuance of the bonds on January 1st, the first interest payment on the 30th of June, and the second interest payment on December 31st. So when we issue the bonds, we're going to debit cash, and we're going to credit bonds payable for the par value. Then the first interest payment on June 30th, debit bond interest expense for that $153,000 that we computed up top, and credit cash. Same thing on December 31st. Okay? So the third problem here is to prepare the journal entry for the issuance of the bonds assuming that they're issued at a discount or at a premium under A and B. So if the bonds are issued at 98, what that means is we're going to receive 98% of the par value in cash. So 3.4 million times 98%, we're going to receive 3,332,000 in cash. We're going to have a discount on bonds payable equal to that 2%, or $68,000, which is the difference between the 3.4 million and the 3,332 in cash that we're going to receive. We're going to credit bonds payable for the par value. Okay? What if it's issued at a premium, which is greater than 100%, right? Bonds are issued at 102, we're going to receive 102% of 3.4 million in cash. So that's 3,468,000. We're going to have a premium on bonds payable, which is an adjunct liability account. So we credit that to increase it for the difference, 68,000. It's a difference over the 3.4 million. We're going to credit bonds payable for 3.4 million. All right, so same problem here. Different numbers. Why don't you pause the recording, give it a try. When you're done, you can resume the recording and we can go through the answers. All right, so how much interest will Boston pay in cash to the bondholders every 6 months? Par value times the semi-annual contract rate, which is 8% times 50%, so 4% every 6 months, equals a semi-annual cash payment of $64,000. Right? Prepare the journal entry for the following. So why don't you pause the recording, prepare the journal entry for the issuance of the bonds on January 1st. Then you can resume the recording and we'll go through the answer. All right, so on January 1st, when we issue the bonds, we're going to debit cash for the par value. I'm going to credit bonds payable for the par value. What about the first interest payment and the second interest payment? Why don't you pause the recording? Give that a try. When you're finished, resume the recording and we can go through the answer. All right, so the first interest payment, we computed already what it is, right? 64,000 each time we pay interest. So we're going to debit bond interest expense rather for $64,000 and we're going to credit cash, $64,000. And then the same would be true on December 31st. Same exact entry. Okay. All right, what about part 3? So prepare the journal entries for issuing the bonds, assuming the bonds are issued at 98% in letter A and assuming they're issued at 102% in letter B. Again, why don't you pause for a minute, give those journal entries a try, and when you're done, resume the recording, and let's go through it. All right, so if the bonds are sold at 98%, that means that 98% of the par value is what we're actually going to receive in cash. So we have 1.6 million times 98%. It's going to be a debit of 1.568 million. We're going to have a discount on bonds payable equal to the difference between the par value and the cash we received. Discounts are contra liability accounts, so they're increased with debits. So that's 32,000. And then our credit to bonds payable for the par value. All right, what happens if they're issued at 102? The cash we're going to get is going to be 102% of par value. It's going to be greater than the par. So we have 1.2%, or 102% rather, times 1.6 million. We're going to receive cash of 1,632,000. We have a premium this time because it's sold above par. So the premium on bonds payable is a adjunct liability account. So in order to increase adjunct liability accounts, we credit for the difference between 1.6 and 1.632. So 32,000 there. And credit bonds payable for 1.6 million. All right, hopefully you did well on that one. Moving on to exercise 10.2. All right, TANO issues bonds with a par value of 180,000 on January 1st, 2018. Bonds annual contract rate is 8%, and the interest is paid semi-annually on June 30th and December 31st. Bonds mature in 3 years. Annual market rate at the date of issuance is 10%, and they're sold for 170,862. So if par value is 180 and they're sold for 178.62, that means they're sold at a discount, right? So what was the amount of the discount on these bonds at issuance? Take 180 minus 178.62, 9,138. How much bond interest expense will be recognized over the life of the bonds? Well, it's 10% each year. So we have, it's 8% each year. So we have 6 semi-annual payments at 4%, which is half, right? If it's 8% for the whole year, you're paying 4% every time you make a payment. So if you take $180,000 par value times 4%, you're going to have 6 annual payments of $7,200 for a total of $43,200. Plus, if you remember when bonds sell at a discount, the amortization of that discount just becomes part of your interest expense. So we have to add our bond discount because that's ultimately going to flow through interest expense. So our discount was 9,138 as we computed in problem 1. So we have total interest recognized over the life of the bonds of 52,338. Question 3, using the straight line method to amortize the discount. Use the straight line method to amortize the discount for these bonds. So if we have 6 semi-annual interest payments and we have a total discount of 9,138 to amortize, let's look at how that works. So we start with 9,138, that's our unamortized discount. And we have a carrying value of 178.62. That was from up above, right? So 9,138 divided by 6 periods. We're going to amortize 1,523 per period. So our unamortized discount is going to come down by 1,523 each period. And our carrying value is going to go up by that amount. Okay? So 7,615 less 1,523 is 6,092. 172,385 of the carrying value plus 1,523 is 173,908. So every time we're subtracting 1,523 from the unamortized discount column, and we're adding it to the carrying value column. Okay? And so when we get to the end, We have no unamortized discount left, and we have a carrying value of $180,000, which is equal to par. All right, so here's the same problem, different numbers. You know the drill. Why don't you pause the recording, figure out what the discount is, figure out what the total interest expense is over the life of the bond, and then amortize the discount using the straight line method. And when you're finished, you can resume the recording and we can go through the answers. All right, so let's start with number 1. What is the amount of the discount of the bonds at issuance? Well, if they have a par value of 97,000 and they're sold, par value of 97, sold for 92,234. Difference between the two of them is 4,766. That's your discount. How much total bond interest expense will be recognized over the life of the bonds? Well, you've got 6 semi-annual payments of 4,850, which is the 97,000 times 5%. 5% is half of the 10% annual rate. Because you're making semi-annual payments, you have to divide that annual rate by 2. So we have 97,000 times 5%. So we're going to make 6 payments of 4,850. So 6 payments of 4,850 totals 29,100. Plus, you have to add your bond discount amortization because that becomes part of interest expense, which is 4,766. We computed that up here. So you have total interest recognized over the life of the bond of 33,866. And then in number 3, using the straight line method to amortize the discount, here's what we do. So we have all of our semi-annual periods there. We have our carrying value starting at 92,234. We need to end at 97. We have our unamortized discount starting at the 4,766, which we computed up here. We need to get to 0. So 4,766 divided by 6 periods means we're going to amortize $794 per period. So if we start with 4,766 less 794, we're going to have unamortized discount after the June 30 semi-annual interest payment of 3,972. And we're going to add 794 to the carrying value to get a total of 93,028. And then we keep doing that every period. So the unamortized discount decreases by 794 each time, and the carrying value increases by 794 each time. Okay. Hopefully you did well on that one. Let's move on to the next. Exercise 10.3. So Brigham Company issues bonds with a par value of 800,000 on their stated issue date. The bonds mature in 10 years and they pay a 6% annual interest in semi-annual payments. On the issue date, the annual market rate for the bond is 8%. So what's the amount of the semi-annual interest payment for the bonds? Well, we take our par value, 800,000, times our semi-annual contract rate. So the the contract rate is the 6%, so it's going to be 3% each time, semi-annual, right? So we're going to pay $24,000 in semi-annual cash interest payments. How many semi-annual interest payments will be made on these bonds over their life? Well, they have a 10-year maturity. It's 20 payments, right? 2 a year. Number 3, using the interest rates given, determine whether the bonds are issued at par, a discount, or a premium. Well, what did we say back in the lecture PowerPoint? We said that if the contract rate is less than the market rate, they're going to sell at a discount. If it's equal to, it's going to sell at neither a discount or a premium. And if it's greater than, it's going to sell at a premium. So in this case, it's going to sell at a discount because the contract rate is less than the market rate, or the market rate is greater than the contract rate. Not sure what the purpose of the house is here exactly, but we're going to roll with it. It's a nice house. Wish my house looked like that. All right. Carrying on. Oh, I have no idea. Now, I don't know. Not sure what the houses are meant to mean, but quite a stark difference, right? When the market rate is lower than the contract rate, the bond sells at a premium. Okay. So, oh, there's our beautiful house again. I have no idea what is happening here. All right, so clearly a difference between the two, right? So I don't know what point they're trying to illustrate. All right, so they want us to compute the price of the bonds at the issue date. So they don't tell us that it's selling at 102 or it's selling at 98, and so we have to figure that out by using the tables to get the factors. And so let's look at how that works. So bonds sell for the present value of the future cash flow. So we have to find the present value of two things: present value of the $800,000 and the present value of the interest payments. So we do that using a table, but we need to know what N is and what little I is. N is the number of payments, so that's 20, semi-annual, 10 years, right? I is the interest rate, the market interest rate, because we're trying to figure out what they're selling for. So the market interest rate is 4% on a semi-annual basis, 8% on an annual basis. They tell us that right here. So then we take, and we have to find the present value of two things. We have to find the present value of the $800,000 now, and we have to find the present value of the stream of income payments over the 10-year term. So the present value of 1 is what we would be using here. And if my clicker worked, I could click on the present value of 1 and we could go to that table and we could see where the two criteria intersect, 20 and 4%, and we would find that the present value of 1 with that criteria returns a value of 0.4564. So if we take 0.4564 times 800,000, the par value, today that money is worth $365,120. Then we have to find the present value of the interest annuity. So that's the present value of an ordinary annuity table, which if I could click on that one, we could, and we looked up where those two numbers intersect, the 20 payments and the 4%, we'd find that that value is 13.5903, and we want to multiply that by our payment amount of 24,000. So the present value of our interest payments is 326,167. They came up with the 24,000 by taking, just make sure here, hold on a second. $800,000 times the 0.03% is 24,000. So the stream of interest payments is going to be at the contract rate. The contract rate is 6% on an annual basis, so 50% of 6 is 3%. So 3% times 800,000 par value is your 24,000 interest payment. So you're going to get semi-annual interest payments of 24,000, and the present value of the present value factor from the table to be applied to the 24,000 is that 13.5903. So you have total present value of 691,287. So our journal entry to record the bonds issuance is going to be cash of that 691,287, discount on bonds payable for the difference to get to 800,000, and credit bonds payable for 800,000. Make sense? All right, so same problem, different numbers. Why don't you pause the recording, take a minute to figure out what the amount of the semi-annual interest payment is, how many total interest payments are going to be made, and if the bond is selling at a premium or a discount. And when you're done, you can resume the recording and we'll go through the answer. All right, so Brigham Company issues bonds with a par value of $570,000 on their stated issue date. The bonds mature in 9 years and pay 8% annual interest and semi-annual interest payments. On the issue date, the market rate is 10%. So, what is the amount of each semi-annual interest payment? Well, par value times the semi-annual contract rate, which would be 4% in this case, equals semi-annual cash payments of $22,800. How many semi-annual interest payments will be made on the bonds over their life? Well, it's a 9-year bond. We have semi-annual payments, so that means they're paid twice a year. So you have 18 total payments. Is it sold at a premium or a discount? Well, if the contract rate's 8% and the market rate's 10, it's looking like it's selling at a discount, right? Not sure again what the point of the houses are, but we'll roll with it. Super fancy that they come up and disappear. It's awesome animation. All right. So here, what we need to do is figure out the price of the bond as of their issue date. And so the bond sale for the present value of the future cash flows. So you have to find out the present value of the maturity or the par value. So present value of one, $570,000, and then present value of the stream of income payments, right? So if we have 18 as in, and we have 5% as our market rate, semi-annual rate, if we look those up in the present value of one table, we would find at the intersection of both of those coordinates that is 0.4155. Take that times our par value. The present value of that par value bond today, the value is 236,835. Then if we look up our coordinates in the present value of an ordinary annuity table, we would find that the value is 11.6896. The semi-annual payment amount is going to be our $570,000 times half of our contract rate, so 0.04. So that's 22,800 times that table value. The present value of our stream of interest payments is 266,523. That means our total present value of our bond is 503,358. So our journal entry to record the issuance of the bond would be a debit to cash, credit to bonds payable for the 570,000, and we'd have a discount for the difference. Discounts are in contra liability account, so they are increased with debits instead of credits. Okay. All right, exercise 10.4. All right, Paulson Company issues 6% 4-year bonds on December 31st, 18. Par value 200,000 and semi-annual interest payments. Use the straight line bond amortization table to prepare the journal entries for the following. So when we issue the bond, they tell us what we start at. That's the amount of cash we're going to get because it was issued at a discount. So we have cash equal to 186,534. We have a discount equal to 186,534 minus the 200,000 par value. And then we have bonds payable for the 200,000 par value. Okay. The first interest payment on June 30th of 19, well, the cash that's going to go out the door is going to be equal to our 200,000 par value times 3%, which is half of our annual contract rate, right? But we have some amortization that's happening, right? So when we amortize our discount on bonds, we have a total discount of 13,466, and that has to amortize over 4 years, so over 8 payments. So if we take 13,466, I think divided by 8 payments, does that work out? 13,466 divided by 8. Yep. So we're going to amortize 1,683 per period. And so our discount on our bonds payable, we're going to credit 1,683. So our total bond interest expense is the sum total of both. So we'll debit bond interest expense for 7,683. Then our second interest payment on December 31st, same idea. Exact same entry. Okay. All right, so same problem, different numbers. Why don't you take a try at it, and when you think you're done, you can resume the recording and we'll go through the answer. All right, so the issuance of our bonds, they tell us what we start our carrying value at, right? So we're going to get cash at 91,307. We're going to have a discount on our bonds payable for the difference between the 98,000 par value and our 91,307 that we got in cash. So we're going to debit 6,693. What about the interest payments? Well, we're going to have bond interest expense, we know. We're going to have cash that goes out the door equal to 10% divided by 2, 5% times our par value, 98,000. We have amortization. We have total bond discount we have to amortize over 8 semi-annual payments because we have 4-year bonds. So if we take 6,693 divided by 8, we're amortizing $836 per period, or 837 rather, rounded. So we're going to amortize our discount. We originally recorded that as a debit, right? So our amortization gets recorded as credits. And the sum total of our bond interest expense is our cash out the door plus our amortization of our discount. Okay? And our second payment's going to be exactly the same. Right? All right. Exercise 10.5. So Dobbs issues 5% 2-year bonds on December 31st, 18 with a par value of 200,000 and semi-annual interest payments. Use the straight line bond amortization schedule to prepare journal entries for the following. The issuance of the bonds. Well, we know we issued it at 188,000. So we issued it at a discount. We're going to get $188,000 worth of cash. We increase cash with debit. We're going to record a discount on our bonds payable because we issued it less than our $200,000 par. So 12,000, difference between 200 and 188, or you could pull it from here. And we have bonds payable for 200,000. Then in B, they want us to record the first through the fourth interest payment on June 30 and December 31st. Well, we know we have a debit to bond interest expense. We know we have a credit to cash. The cash that we're going to pay our bond holders is going to be our par value. Oh, so that was messy. Our par value of 200,000. We have a 5% annual rate. So 2.5% is going to be our semi-annual rate, right? 2 payments in a year. So we're going to have cash out the door of 5,000, and then we have discount on bonds payable that we're amortizing. So we have a $12,000 total discount, right? We have 2-year bonds, so that's 4 payments. So $4,000 divided by 4 is 3,000 each period we're going to amortize. So we have our discount on our bonds payable, the amortization of that, credit of 3,000, so our total interest expense is 8. Same exact entry for 12/31/19, same exact entry for 6/30/20, same exact entry for 12/31/20. When we make that last entry, our unamortized discount goes to 0, and our carrying value is 200, equal to the par. All right, and then finally they want us to record the maturity of the bonds on December 31st of 20. Well, we're going to pay back our bondholders, right? So we're going to reduce our bonds payable. We do that with the debit. We're going to credit cash. Easy peasy. All right, same problem, different numbers. Why don't you take a minute to record the issuance of the bond and then also record the semi-annual interest payments and then also the disposal of the bond or the maturity of the bond. And when you're finished, you can resume the recording and we can go through the answers. All right, so the issuance of the bonds. We know we issued it at a carrying value of 1,038 with an unamortized discount of $6,200, right? So we're going to debit cash for 1,038. We're going to credit bonds payable for the 110 par value. We're going to debit discount on bonds payable for $6,200. Then to record our first through our fourth interest payments on June 30th and December 31st, we're going to get cash, or we're going to pay cash rather, equal to our par value of 110,000 times our semi-annual interest rate. Our annual rate's 5%, so 50% of that for semi-annual is 2.5. So we're going to pay our bondholders $2,750 every 6 months. We have our discount on our bonds payable. We have $6,200 that we have to amortize over 4 periods. So $6,200 divided by 4 is $1,550. So we're going to amortize $1,550 every period, and our total bond interest expense is going to be the sum total of the two. So our discount on bonds payable is originally recorded as a debit. It's a contra liability account. So to decrease it, we credit. We make that same payment every single time. After we make this last payment on 12/30/20, our unamortized discount is 0 and our carrying value goes back to 110. What about the maturity? When the bond matures, we're going to pay our bondholders back, right? So we reduce our bond payable, and we do that with a debit. We reduce our cash, credit. Okay? All right, exercise 10.6. Woodwick issues 10% 5-year bonds on December 31st, 17, with a par value of $200,000 and semi-annual interest payments. Use the straight line bond amortization table to prepare journal entries for the following. All right, issuance of the bond. They tell us what we start our carrying value at on December 31st, right? So when we issue the bond, we're going to get $216,222 in cash. We have a $16,222 amortization of our premium to start. So premium is recorded as an adjunct liability, so it works the same way as liability accounts and thereby increased with credits. We have our bonds payable for $200,000. So the difference with premium rather than discount is premium actually, when you amortize it, it reduces your interest expense rather than increases. Okay? So we have bond interest expense that we're going to debit. We know what our cash out the door is going to be. It's going to be our $200,000 times our Whoa, I did not scribble that way. Please hold. Looks like I'm drunk. Jeez, oh Pete's. All right. Never lecture. Never drink and lecture, right? Ha. Kidding. No, actually, I don't do that. Okay. Par value $200,000. 10%. Half of that is 5%. So our cash out the door is going to be 200,000 times 5%, $10,000. Our amortization of our premium, we have to amortize our premium. 16,222 over 10 periods. It's 5 years, semi-annual, so 10 periods. So we're going to amortize 1,622 each period. So we have a premium on bonds payable being amortized. We amortize the premium with debit because it's originally recorded as a credit, right? So our bond interest expense is going to be the net of the 10,000 and the 1,622. So we have bond interest expense of $8,378. Okay. The second payment, same thing. Okay. Easy peasy lemon squeezy. Same problem, different numbers. Why don't you record the bonds at issuance and then also record the semi-annual payments and amortization of premium? And when you are through, you can resume the recording and we will go through the answers. All right, so Woodwick issues 7% 5-year bonds on December 31st, 17 with a par value of 106 and semi-annual interest payments. So, using the straight line bond amortization schedule to prepare the journal entries, for the following. So the issuance of the bonds, they're issuing at 114,231. And we know the unamortized premium is 8,231 to start on December 31st, right? So we have cash. equal to the carrying value of 114,231. We have bonds payable equal to our par value of 106. And we have premium on bonds payable as a credit for the 8,231. The first interest payment on June 30th of 18 is going to be equal to the 106,000 times half of 7%, because that's our semi-annual rate. So 106,000 times 3.5%. We're going to have cash out the door of 3,710, but we have amortization of our premium that's going to offset that. And so if we take our 8,231 total premium divided by 8,231 divided by, they're 5-year bonds, so there's 10 payments, so divided by 10, that means we're going to amortize the $823 each period. So that's a debit to bonds premium, or premium on bonds payable. So we have a net interest expense of $2,887. And then our second payment is going to be exactly the same. Okay. All right, exercise 10.7. Quattro Company issues bonds dated January 1st, 18 with a par value of $400,000. The bond's annual contract rate is 13%, and the interest is paid semi-annually on June 30th and December 31st. Bonds mature in 3 years. Annual market rate at date issuance is 12%, and bonds are sold for $409,850. What's the amount of premium on the bonds at issuance? Well, they're sold for $409,850. They have a par value of $400. Premium's the difference between the two, $9,850. How much total bond interest expense will be recognized over the life of the bonds? So when you're talking about premium, the premium amortization offsets your actual cash payments of interest. So here's how this works. So we have 6 semi-annual payments of $26,000. So how we came up with that $26,000 is the $400,000 par value times 13% divided by 2, because that's the annual rate. Okay, that's $26,000. So if we have 6 payments of $26,000, that's 6 times $26,000 is $156 total interest, less our premium on bonds payable, $9,850. So we have a net of $146, $150. Using the straight line method to amortize the premium for these bonds. Well, let's set up our table. So we have the issuance, right? So our unamortized premium at issuance is this $9,850. Our carrying value is that $409,850 that it issued at, right? And so over the next 1, 2, 3, 4, 5, 6 payments, we need to take that unamortized premium to 0 and our carrying value down to $400. So if we take 9,850 divided by 6, we should be amortizing 1,641 or 642 every period. And so our unamortized premium is going to decrease by 1,642 each time we make an interest payment. Our carrying value is also going to decrease by that same amount. So 9,850 minus 8,208, 409,850. Or I'm sorry, I should say it this way. 9,850 less 1,642 equals 8,208. 4,000 or 409,850 less 1,642 is 408,208. And so each period you subtract from the previous number the 1,642 until we get down to 0. And a 400,000 carrying value. Okay? All right, same problem, different numbers. Why don't you compute the amount of the premium on the bonds at issuance, what the total interest expense is, and then also the amortization of that premium. And when you're finished, resume the recording and we will go through the answers. All right, so our premium is $809,071, which is what it's sold for. less our par value of $770 for a total premium of $39,071. How much total bond interest expense will be recognized over the life of the bond? Well, we've got $770,000 par value times half of our contract rate is our semi-annual rate. So times 6%, that's 6 semi-annual payments of $46,200. So 6 times $46,200 is a total interest payments of $277,200 over the life of the bond. We have a premium of $39,071 that is going to reduce our interest expense. So we have a net of $238,129. So using the straight line method to amortize the premium, set up our table, carrying value in one column, and we have our unamortized premium in the other. So we have to, our carrying value, we start at 809,071. We need to get to 770. Our premium, we start at 39,071. We need to get to 0. And so we have 39,071 divided by 6 payments. So that means we need to amortize $6,512 each period. So 39,071 minus 6,512 is 32,559. 809,071 minus 6,512 is 802,559. And then from each of those totals, we just keep subtracting every period the $6,512. So it's reducing by 6,512 each time till we get to 0. Okay? All right, exercise 10.8. Citywide Company issues bonds with a par value of $150,000 on their stated issue date. The bonds mature in 5 years, pay 10% annual interest and semi-annual payments, and on the issue date, the annual market rate for the bond is 8%. So, what is the amount of each semi-annual interest payment for the bonds? Well, we take our par value times our semi-annual interest rate. So our annual rate is 10%, so our semi-annual rate would be 5. So we take 150,000 times 5%. Each of our payments is going to be $7,500. How many payments will they make over the course of the bond's life? It's a 5-year bond. We're making payments twice a year. 5 times 2 is 10. Use the interest rates given to select whether the bonds are issued at par, at a discount, or at a premium. Well, we're paying 10%, but the market rate's 8. If the contract rate is greater than the market rate, we're selling them at a premium. And then in 4, compute the price of the bonds as of their issue date. So this is the same thing with the tables here. So bonds sell for the present value of their future cash flows. So we have a 5-year bond with semi-annual payments. So N is equal to 10. Our market rate is 8%. So we're going to use 4 in the intersection of N equal to 10 and I equal to 4%. When we look that up in the present value of 1 for the par value amount, we're going to find that the $150,000 par today is worth $101,340. Because when we look up N equal to 10 and I equal to 4% in the present value of 1 table, we're going to get 0.6756. The income stream of interest payments is going to be the present value of an ordinary annuity table. And so if we were to look up the intersection of N equal to 10 and I equal to 4 in the present value of the annuity table, we're going to get 8.11.09 or 8.1109. So if we take that times our semi-annual interest payment, which is based upon the contract rate, right? So $150,000 par times 5%, because our annual rate's 10, we would get $7,500 as our annuity payments or our interest payments. So 8.1109 times 7,500. The present value of our interest payments is going to be $60,832. So we have total present value of $162,172. So if we prepare the journal entry to record the bond's issuance, we're going to record cash equal to the 162,172 present value. The premium on the bonds payable is going to be the difference between 150 and 162,172. So that's going to be 12,172. We're going to record our bond payable at par, $150,000. All right, so same thing here. Why don't you figure out what the semi-annual interest payment is for the bond, how many total payments there will be, whether it's selling at a discount or a premium, and then we'll pause again on the next slide before we go through those problems. So take a minute, figure out those three answers, and when you're done, you can resume the recording, and we will go through the answers. All right, so the amount of the semi-annual interest payment for this bond is going to be equal to the par value of $67,000 times the semi-annual interest rate. So 11% is the annual rate, so 5.5 would be our semi-annual rate. So that means each of our interest payments are going to be $3,685. So how many semi-annual interest payments will be made over the life of this bond? The bond is a 5-year bond, so we're going to make payments twice a year. 5 times 2 is 10. And then using the interest rates given, determine whether the bond's issued at par or at a discount or at a premium. Well, we have a contract rate of 11. We have a market rate of 10. When the contract rate is greater than the market rate, they sell at a premium. Okay. All right, now, why don't you take a minute and compute the price of the bonds? I think you can find in the book in McGraw-Hill or online. I think you can find it as well. You want the present value of one table and the present value of an ordinary annuity table would be the two that you need to compute the price of the bond. Take a minute, do that. When you're finished, you can resume the recording and we will go through the answers. All right, so bonds sell at the present value of their future cash flows. So we have two present values. We need the present value of the par value payment that we're going to make at the end of the term and when the bond matures, and then we also need the present value of the annuity payments or the interest payments. So we need to know what N is and we need to know what I is in order to look up the factors in the tables. N is equal to 10. It's the number of payments, right? 5 years, semi-annual. 5 times 2, 10 payments. The interest rate is going to be 5%. It needs to be the market rate because we're figuring out the selling price, right? So we're using market rate for this. So 5% is the market rate, the semi-annual rate. So the present value of 1, par value, we looked up N at 10 and I at 5% in that present value of 1 table. We come back with a factor of 0.6139. So if we take 0.6139 times $67,000 par value, present value of that is $41,131. Then we have to figure out what the present value is of all those interest payments. So we're going to look up the N and the I in the table, but this time the present value of the ordinary annuity table, and it would return the factor 7.7217. We're going to multiply that by the semi-annual interest payment that we figured out on the previous slide, or it's right here. So that times 3,685 is going to be a present value of 28,454. So our total present value of our future cash flows related to this bond is 69,586. So when we record the journal entry for the bond's issuance, we're going to receive cash equal to 69,586 present value. The bond has a par value of 67,000, so we're going to have a premium equal to 2,586, the difference between the cash received or the present value and the par value. And then we issue our bonds payable with a credit of $67,000. Okay. All right, exercise 10.9. All right, so on January 1st, Shea issues 700,000 of 10% 15-year bonds at a price of 97.75. 6 years later, on January 1st of 2024, they retire 20% of the bonds by buying them on the open market at 104.5. All interest is accounted for and paid through December 31st, 23, the day before the purchase. So the straight line method is used to amortize any bond discount. So first they want us to tell them how much does the company receive when it issues the bonds on January 1st of 18. Well, they're $700 par and they issue them at 97.75. So 700,000 times 97.75, they're going to get 684,250. Well, if that's what they're getting, that means it's selling at a discount, right? Because they sold them for less than par. So the discount is going to be equal to par less whatever they sold it for, right? Or issued it for, rather. So that's going to be 700,000 less 684,250 for a total discount of 15,750. They want to know how much of the discount is recorded on the books for the entire period between January 1st, 18 and December 31st, 23. So how many years is that? We have 18, 19, 20, 21, 22, and 23. So that's 6 years. I did just count that on my fingers in case anybody wondered. So in 6 years, if the original discount is 15,750 and the term is 15 years, that means the amortization per year is $1,050. There's 6 years amortized through the date of the sale, so that means that we have amortization through 2023 of $6,300. All right, so I think this is the exact same problem. Here we go. Question 4. What is the carrying book value of the bonds and the carrying value of the 20% soon-to-be retired bonds as of the close of business on December 31st, 2023? So, the par value of the whole group of the bonds is 700,000. The remaining discount is the difference between our total discount of 15,750 plus everything we've amortized to date through December 31st, 23. So the amount remaining is 9,450. So we have a carrying value of 690,550. We're going to retire 20%. 700,000 times 20% is 140,000. Remaining discounts, 20% of 9,450 is 1,890. So we have a retired total carrying value of 138,110. So in question 5, how much did the company pay on January 1st, 2024 to purchase the bonds that it retired? Well, they tell you they bought them on the open market at 104.5. So par value of 140,000 for the retired piece times 104.5 means they bought them at 146,300. So the gain or loss from retiring the bonds is going to be the difference between the carrying value of the retired bonds, 138,110, and the amount they had to pay to retire them, 146,300. So we have a loss of 8,190 on retirement. So the way we record that journal entry is we reduce our bonds payable for the portion, the par value that we're retiring, 140,000. We reduce bonds payable with debits. We record our loss on retirement that we just computed right here of 8,190. Losses are debits. We record the reduction in our discount on bonds payable for the retired piece of 1,890. Discount on bonds payable is a contra liability normally, so it normally has a debit balance. So we need to reduce it, and the way that we do that for the 20% retired piece, the way we do that is with a credit. And then we have cash of 146,300, which is what we paid to retire the bonds. Right here. Okay? All right, so same problem, different numbers. So why don't you take a few minutes, figure out how much the company receives when it issues bonds, find out how much the bond discount is. And I don't remember the third question, so we'll pause again after you do those two. All right, so on January 1st, 18, Shay issues $360,000 of 11% 20-year bonds at a price of 97.5. 6 years later, she wants to retire these bonds by buying them back on the open market at 104.75. All interest is accounted for and paid through December 31st, 23, the day before the purchase. And the straight line method's used to amortize bond discount. So how much does the company receive when it issues these bonds? Well, par value is 360,000 times the selling price at 97.5, 351,000. What's the discount? It's just the difference between the par and the selling price, right? So 360 minus 351, $9,000. So then how much amortization of the discounts recorded on the bonds for the entire period between January 1st, 18 and December 31st, 23? So 6 years, right? So 18, 19, 20, 21, 22, 23. Yes, I did just do that 5 minutes ago, and I recounted on my fingers. Don't judge. So we have 6 years, right? So our original discount's 9,000. The term is 20 years. So the amortization per year is $450. 6 years have passed. So that means the amortization through December 31st, 23 is $2,700. Okay. What's the carrying value of the bonds and the carrying value of the bonds and the carrying value of the 25% soon to be retired bonds at the close of business? So par value of our entire group was 360,000, right? The remaining discounts as of December 31st, 2023 is the difference between our original, 9,000 less what we've amortized to date. $6,300 left. So our carrying value of the entire group is $353,700. If we're going to retire 25%, multiply each of those lines by that 25%. So the par value of what we want to retire is 90. The remaining discount of what we want to retire is 1,575. So that means the carrying value is 88,425. All right, so how much did the company pay on January 1st, 2024 to purchase the bonds it retired? Take a minute, figure that out, and when you are done, you can resume the recording and we will go through it. All right, so the bonds that they retired, they said they bought on the open market for 104.75. So we have the 90,000 of what we want to retire times the 104.75 that they tell us up here in the problem. That means we bought them back for 94,275. What's the gain or loss recorded from retirement of the bonds? Well, carrying value of the retired bonds was 88,425, right? Right here. The amount paid to retire the bonds, this 94,275 we just computed. So that means we have a loss on retirement of 5,850. What's our journal entry? Well, we need to remove our bonds payable for the 25% that we're retiring, right? So that's a debit of 90. We have to remove the remaining discounts on bonds payable that we're retiring, so that's going to be a credit of 1,575. We know what our loss is. We already computed that, 5,850. And the cash that we're paying for the new one, or the retirement of the bonds on the open market, is 94,275. All right, exercise 1010. All right, so on January 1st, 2018, Eagle borrows $100,000 cash by signing a 4-year 7% installment note. So the note requires 4 equal total payments of accrued interest and principal on December 31st each year from 2018 to 2021. So compute the amount of each of the 4 equal total payments. Well, the way we do this is we figure out what we have to pull the factor from the present value of an annuity table. So we have a $100,000 note, but we need to divide that by our table value. And we're going to use the present value of an ordinary annuity table. And if we pick up the intersection of 7% and 4 installments, we'd find that that factor is 3.3872. 100,000 divided by 3.3872 is going to be an annual payment equal to $29,523. So if we were to prepare the amortization table for the note, we're going to start with $100,000. Our interest expense is going to be equal to our principal balance times our 7% rate. So our interest expense is going to be $7,000. Our total payment is $29,523. So if we take $29,523 minus $7,000, that means the principal, or the reduction in our note payable for that first payment, is going to be equal to $22,523. Total cash is $29,523. So every time we make a payment, we're going to debit interest expense, debit notes payable, and credit cash. So our ending balance is going to be the difference between our beginning balance and the amount that we paid on the note that didn't get applied to interest. So our ending balance is going to be $77,477. So now our beginning balance is that $77,477 times 7% is $5,423. If we take our total payment amount of $29,523 less that interest piece, that means we're going to pay $24,100 on our principal, or our note balance. Total cash is still going to be $29,523. $77,000 less $24,100, which is the amount being paid to principal, is going to give us an ending balance of $53,377. $53,377 times 7% is $3,736. The difference between our total payment amount of $29,523 and $3,736 means we have $25,787 reduction in our note payable balance for our principal, right? So total cash is still the same. So our beginning balance of $53,377 less our total credit of our total debit to our note payable rather of $25,787 leaves us with an ending balance of $27,590. That becomes our beginning balance times 7%. The rest of our $29,523 payment is going to get applied to note. And so $27,590 less $27,590 of principal is going to take us to 0. Okay, so we paid interest over the term of the note of $18,090. We've paid principal of $100,000. Total reduction in cash, $118,092. All right, so same problem, different numbers. Why don't you compute the amount of each of the 4 equal total payments and then the amortization schedule? And when you're finished, you can resume the recording and we will go through the answers. All right, so our $35,000 note divided by our table factor. And our table factor would be determined by looking up 7%, the intersection of 7% and 4 in the present value of an ordinary annuity table. You would find that factor to be 3.3872. 35,000 divided by 3.3872 means our annual payment of $10,333. So we're going to start with $35,000 beginning balance. We're going to pay $10,333 in cash each of the 4 years. So 35,000 times 7% is $2,450. We know our total payment is $10,333, so that must mean the amount that's getting applied to principal and thereby reducing our note payable is $7,883. 35,000 less 7,883 is $27,117. That becomes our new beginning balance times 7%. Means what we have left over of our cash payment of $10,333 gets applied to principal. thereby reducing our note payable balance with a debit. So 27,117 less 8,435 is 18,682. So on and so forth. Does your amortization table look like that? I hope so. Total interest 6,332. Total principal paid 35,000. And total cash out the door 41,332 over the 4 years. All right, exercise 1011. All right, so this is the same problem as, well, problem before last, the one that we did together before you did the one on your own. So this is the exact same amortization table, but what they're doing this time is they're taking it a step further. If I get through all my clicks here. So this is all stuff we've been through and you've seen. What they're asking us here now is to book the journal entries related to each of the payments. So on January 1st of 18, when we get the cash for the note, we're going to debit cash 100,000 and we're going to credit note payable. That's the issuance, right? Then on 12/31 of 18, when we make our first payment, we're going to debit interest expense for that $7,000. We're going to debit our note payable to reduce the balance for the first payment by that 50 or the 22,523, and we're going to credit cash for the 29,523. Then our second payment is going to be debit to interest expense, debit to note payable, and credit to cash. Then our third payment is going to be debit to interest expense for that 3736, debit to notes payable for 25,787, and credit to cash. And then our final payment is going to be debit to interest expense for 1,931, debit to notes payable for 27,590, and credit to cash. So this again is the same problem you just did. Let me click through and get all the AM table stuff to show up. And so why don't you take a minute and record all of the journal entries, both for the issuance of the note and for each of the payments. And when you're finished, you can resume the recording and we can go through the answers. All right, so on January 1st of 18, when they take out the note, we're going to debit cash for 35,000 and credit note payable for 35,000, right? Then when we make our first payment, we're going to debit interest expense for this 2,450, debit notes payable for 7,883, and credit cash for 10,333, right? Then second interest payment, debit interest expense for 1,898, that's this guy here. Debit notes payable for 8,435, and credit cash. Same thing for 20. So you're really just recording the journal entry by bringing down the amounts that you have in your AM table or your AM schedule. Okay? Makes sense? I hope so. Hope you did well on that. Let's move on to the next. Exercise 10. So Montclair Company is considering a project that will require a $500,000 loan. It presently has total liabilities of $220,000 and total assets of $610,000. So what they'd like us to do is to compute the present debt to equity ratio and then the debt to equity ratio, assuming it borrows the $500,000 to fund the project. So before the loan, total debt was 220 divided by total equity of 390 means they have a debt to equity ratio of 0.56. After the loan, we've got total debt of 220 plus 500,000. So 720 divided by total equity of 390, they have a debt to equity ratio of 1.85. Right, same problem here. Why don't you take a minute, see if you can't solve the two debt to equity ratios. And when you're finished, resume the recording and we will go through the answers. All right, in letter A, their present debt to equity ratio, they've got total debt of 190,000. They've got total equity of they have total assets of 650 and they have total liabilities of 190. So what does that mean? If we bust out our accounting equation, assets equals liability plus equity, right? Oh gosh, this pen is getting worse and worse. They have total liabilities of 190. Oh my goodness, that's supposed to be a 9. And they have total assets of 650. 650 less 190 is what? 460, right? So 190 divided by 460 is a debt to equity ratio of 0.41. And then what happens if they take on that loan? So they had 190 of debt, but they're going to add 560 to it. So now we have 750,000 of debt divided by total equity of 460. Their ratio is going to go to 1.63. All right, guys, that wraps up chapter 10. So hopefully you found this to be helpful. As always, as you're working through the exercises or the homework assignments, if you have any questions, please don't hesitate to reach out. Best of luck.